There are many investors still using the 60-40 portfolio strategy. You can easily understand that by the amount of news and articles you read every day about the benefits of its deployment. But after all these years of investing evolution and market change, is a strategy that took from almost 60 years ago still relevant? And if yes, is it for everyone? In this video, I'm going to give you my take on the 60-40, what kind of investors can have the most benefit from it, and what are some very interesting methods to modernize it in a way to fit different investment strategies. Let's start. So the stock market is a system that tends to follow tradition, and traditionally investors have been expected to start young, build a buy and hold portfolio, and be careful with asset allocation in order to avoid high levels of risk. Much has changed in investing over the past couple of decades, with robo-advisors making moves for many investors, access to the market widely available through discount brokers, and a rise in short-term trading. Still, many people feel more comfortable investing in the traditional ways, which is what makes the highly traditional 60-40 portfolio so popular. The 60-40 has been around for decades and is more of an investment strategy than a defined portfolio because there are no assets set in stone. The strategy is based on a safe asset allocation method that has been used in retirement accounts for decades now. It suggests 60% of investment assets should be invested in equities like stocks, ETFs and mutual funds, and the other 40% of the portfolio's assets should be invested in fixed income securities like US Treasury bonds, corporate bonds, and other debt securities that produce income through interest rates or a discount on the price of the security. The idea behind is that by diversifying your portfolio across asset classes that experience different levels of volatility and risk, you'll be able to access the gains the stock market provides during bull markets while minimizing losses during downturns or all-out bear markets. As with any other portfolio strategy, there are advantages and disadvantages that should be considered before diving into. Okay, let's start with the pros. Here are some of the most exciting aspects of the portfolio. First, it can be diversified to the max. The portfolio, although made up of only a few assets at most, is designed to be highly diversified, offering complete exposure to whichever sector of the market you prefer. The mix of underlying assets in each fund acts as an insurance policy against volatility. Secondly, through the strict asset allocation rule, risk is evenly balanced. While there are opponents to the idea of fixed allocation, this is a tried and true strategy that's been used for decades. Finally, there are very few assets to keep track of here. This makes maintaining balance and managing your portfolio an extremely simple process. While there are plenty of reasons to be excited about deploying this portfolio strategy, there are also a few drawbacks that should be considered before diving in. Firstly, asset allocation is fixed at 60% stocks and 40% bonds, which is rather modest for younger investors and a bit risky for those nearing retirement. Most financial advisors suggest following a fluid allocation strategy that changes as your risk tolerance and goals change. Then we have bond yields. In recent years, the market has been experiencing historically low bond yields as a result of a low interest rate environment. By allocating such a large percentage of your portfolio to fixed income investments, you could be missing out on much of the gains the bull market has to offer. Because the 60-40 portfolio is so customizable, I believe it's a great fit for various kinds of investors, as it can be adjusted for different risk levels. The strategy is based on a strict asset allocation of 60% equities and 40% fixed income investments. Many experts disagree on what an optimal asset allocation looks like. Because your goals and appetite for risk are likely to change over time, many suggest using your age to determine the split between equities and fixed income investments. For example, instead of allocating 40% of your assets to bonds and other debt securities and 60% to equities in all cases, this variation on the strategy suggests if you are 21 years old, you should allocate 21% to fixed income securities and 79% to equities. This variation involves adjusting your holdings as you age to include more fixed income assets and fewer equities, becoming more conservative as you near retirement. But that does not mean that the fixed allocation of the 60-40 portfolio could not be adjusted to modulate your risk to be heavily moderated or aggressively accepted, depending on your age and investment goals. That's because the contents of a 60-40 portfolio aren't set in stone. It's more of a guide explaining how you may want to go about asset allocation that can be applied to several different investment strategies. As a result, there are several ways to go about building the portfolio, a task made easier by the abundance of low-cost ETFs on the market today. So let's quickly see 6 popular ways to build a 60-40 portfolio for yourself based on your investing strategy and risk tolerance. The funds mentioned here are low-cost Vanguard index funds, but you can choose any fund you like that gives you exposure to the same types of assets. For investors with a low risk tolerance who want access to the market as a whole, the build of the portfolio is best as follows: 60% in Vanguard Total Stock Market Index Fund ETF. This is one of the most diversified ETFs on the market today. The VTI is designed to give investors exposure to the total United States stock market. The past performance of the fund has been stellar, beating others in its category relatively over the past 10 years. 40% in Vanguard Intermediate Term Treasury ETF. The VGIT is focused solely on intermediate term, high quality US Treasury securities. While these government bonds come with relatively low yields compared to longer term options, their yields are stronger than short-term bonds and liquidity is reasonable. While the low-risk 60/40 portfolio is a great option for many, investors know that the lower the risk associated with the investment, the lower the potential for gains. One great way to slightly increase the risk while greatly expanding your earnings potential when using this portfolio strategy is to include international stocks in your equity holdings and swap out treasury bonds for corporate bonds in the bond portion of the portfolio. And here's how that looks. 60% in Vanguard Total World Stock ETF. The VT ETF fund was designed to provide exposure to a highly diversified list of stocks both in the US and around the world. While the international side of the portfolio increases the risk, it also increases potential profitability as emerging market growth tends to outpace growth in established markets like the United States. Now the other 40% goes to Vanguard Total Corporate Bond ETF. On the bond market, corporate bonds are known for paying higher yields than treasury bonds, but do come with increased risk. By investing in the VTC fund rather than VGIT, it's possible to increase the earnings on the fixed income side of your portfolio. If you're willing to accept higher levels of risk, the potential returns can be increased by including some different asset classes into both the equity and fixed income sides of the equation. Among your equities, consider mixing in some small cap holdings. Small cap stocks are known for high levels of volatility and risk, but they're also known for the potential to outpace the returns of their large cap counterparts. On the fixed income side, look into real estate investment trusts or REITs. These real estate investments are riskier than bonds but have much greater potential to increase your profitability while providing a source of predictable returns in the form of exceptional dividends. Adjusting the portfolio for a higher risk investor is as simple as investing in the following funds. The VT fund should represent about 30% of your holdings in the higher risk edition of the 60/40 portfolio or half of your equity allocation. Next is the Vanguard Small Cap ETF. The VB fund is made up of a diversified group of small cap stocks, providing exposure to high growth opportunities in smaller companies. This fund takes the other 30% allocation on the stock side of the portfolio in this model. About half of your fixed income allocation, or 20% of the total portfolio, should be invested in the VTC fund to gain exposure to corporate bonds. Finally, the V&Q fund is an index made up of investable REITs, which gives you broad access to real estate investments while maintaining diversification within the asset class. This fund makes up the other half of your fixed income allocation, representing 20% of the portfolio. Now, if you'd rather focus on a growth strategy than simply making bucket investments in diversified groups of equities, the Growth 60/40 portfolio is the way to go. And here's what it looks like. 60% in Vanguard Growth Index Fund ETF. The VUG fund was designed to provide diversified exposure to US large-cap growth stocks. These are companies that have a proven history of generating significant growth, but provide a level of safety in that they are all large-cap established companies. In the growth edition of the portfolio, this fund represents 60% of your investment allocation. The other 40% of the portfolio would be invested in the VGIT, offering stability through intermediate-term treasury securities. If you're following a value investing strategy, the best way to take advantage of this portfolio is to invest the stock portion of your assets into a value-centric fund like the Vanguard Value Index Fund. VTV provides diversified exposure to large-cap value stocks, meaning these are large-cap companies with valuation metrics that suggest they are trading at a discount. You can then invest the remaining 40% of your assets using the VGIT for your bond holdings. Finally, those focused on income investing can also take advantage of this portfolio with one small tweak. As with the traditional 60/40 portfolio, 40% of your assets should be allocated to the VGIT, providing safety through investments in intermediate-term treasury securities. The other 60% of the portfolio should be invested in the Vanguard High Dividend Yield. The VYM is made up of a wide range of stocks known for paying high dividend yields. By investing in the fund, you'll gain diversified exposure to stocks of all sizes in various sectors that all have one thing in common. They all have a history of offering investors a high dividend yield. That's music to an income investor's ears. Regardless of which edition of the 60/40 portfolio you choose to go with, it's important to make sure to maintain balance. The entire thesis behind the portfolio is to provide meaningful returns while creating a safety net by balancing higher risk equities with low risk fixed income investments. As time passes, some investments will rise in value and others may fall. As a result, your investment portfolio will fall out of balance. If the balance becomes too skewed, the portfolio may fail to meet your investment objectives. Now, the good news is that the 60/40 portfolio strategy is a buy and hold strategy, meaning you won't be required to rebalance your portfolio monthly. However, it is best to take a look at your portfolio on at least a quarterly basis. Moreover, with so few assets, maintaining balance is a relatively simple process. When one asset grows to take up more than its allocated percentage, simply sell a little of it and buy more of its counterpart to bring the portfolio back to the 60/40 balance. There's a reason the 60/40 portfolio is one of the most talked about strategies on Wall Street. For decades, investors have been deploying this strategy, which has worked to build wealth over time. If you want to find out more about investing, please have a look at these videos. See you next time. Bye bye.